It's the equivalent of saying, what's your entry point on a stock, right? What's your entry point on duration?
That's a good question. I guess we probably will have a range in what fair value the 10-year would be, but that's a question we should discuss more, but I don't have like an exact answer for that.
Thank you.
Can I ask a question?
Wait, I'll let you know right after you ask the question.
Okay. I used to manage bonds, and when interest rates were going up, or the thought that interest rates were going up, or we thought inflation was going up, we'd go to 3 months duration and only have index inflation-linked bonds. Why can't we do that here? 0 bonds or 3 months bonds and inflation-linked bonds only. Lock in your profits and just move on.
Oh, that's an absolute return question. They're in a relative game. Yeah.
So are you basically asking us why we don't have a 3-month duration?
I'm asking, why don't you have 3 month duration, lock in your profits and buy inflation-linked bonds?
I think that's a great question that you propose. And I think the team would be very excited to be much more of an active manager in that way, where we have a much shorter duration where, like you said, we can lock in profits. But according to our IPS, I believe that we're supposed to be having an investment horizon of 5 years. That's normally what we apply when looking for new investments. But like you said, this is the environment to do the strategy that you're proposing, but just based on the requirements that were proposed at the beginning of the year, that's why we haven't taken that strategy on.
Is that correct, bond team managers? That you got a compliance limits?
Anyone, what's your lowest duration band according to the IPS? That's essentially what we're trying to get to, right?
Yes, plus 1 or 2 years from the benchmark. So that's all right.
My case rests. Thank you, guys. Hello, Dom.
Thank you for your question.
Yeah, I have a quick question. Can I ask questions on the economic slides? Is this the same one, or is that a different team?
You missed your chance. No, I'm just
Oh, I
kidding.
did.
No, of course you can.
Can you guys go to the last slide of the economics presentation? Yeah, so on the left side, short term, you guys say moderately increasing inflation. What is moderate? Put a percentage on that.
I would say just like under 2%. I believe that was the target rate from the Fed that they had put in place.
So if we're getting numbers that are like 4% right now, is it moderate still?
No, I wouldn't consider that to be moderate.
So if that's already happening, how would that kind of change your outlook?
Yeah, just to go on that, just on the outlook for, especially on the equity side, companies with low earnings or even negative earnings are going to impact most directly. So a lot of infotech stocks, software, high growth stocks, or momentum stocks with low earnings are going to be the most directly impacted in terms of valuation, more on the equity side. So
that's fair. Yeah, so I'm looking at the CPI right here, and I mean, it was, what was this, Tuesday or Wednesday, whenever it came, I think it was Wednesday. 3% year over year core, 4.2% year over year, all in. So those are pretty big numbers if you're saying 2%'s moderate. So I guess on the, we have the equity answer. What about the bond portfolio? Does that make you guys think, as to Dom's point, that maybe the 10-year is still too low, or does it change your outlook at all?
Yeah, I believe during this section, we were just revisiting what we had originally, our analysis from last time we met back in October. So that's what Dylan was going over, that was our original projections. I do believe, like you said, it has changed. So I do believe that our assessment has changed as well. Personally, I believe that as inflation is rising, like we're gonna have to keep a lower duration, most definitely. And I don't believe that we're done. We're capped out at the levels that we're at right now.
Okay, and then one more from me, or one or two more. So I guess kind of building on that, you guys cited the Fed. Do you guys buy the story that inflation is going to be transitory, and a year from now maybe it's not as bad? And how does that impact what you just said?
I think this just goes back to our active management. We have to continuously keep updating our outlook to make sure that we're in line with what's happening in the world. So as of now, I believe that we still believe that it's going to keep rising. But like you said, as things progress and we see easing from the Fed, we definitely will update our outlook at that time.
That's fair. I mean, these are hard questions. No one knows the answers to these questions. So I just wanted to see how you guys would answer. So thank you.
Of course. Thank you.
Ryan, could you expand? You were talking about stocks or growth stocks with low earnings were susceptible. Did you mean high price earnings ratio stocks, highly valued growth stocks? What did you mean by low earnings?
Yeah, so companies that have rich valuation, high PEs, high EV to EBITDA, companies, lower earnings. When you're discounting in the future, if they're low, it's going to be impacted more in terms of equity risk premium, WACC. It's going to affect the tech stocks more directly than other sectors specifically.
Yeah, all right. I thought that's what you were referring to, and maybe we'll end up discussing that with the equity team. Thanks.
Yeah, no problem.
Any other questions for the bond team?
I'll ask a kind of a non-bond question. You mentioned that, I think Azan said that they maybe could have moved sooner sometimes, and maybe, I'm curious, just being remote this year, you know, how do you think that affected your ability to work a little faster and make decisions quicker? And then how did you adjust during the year?
Yeah, great question. I guess it was difficult initially to kind of, for the last semester, I'm pretty sure most of the teams can agree, to understand like exactly what the process was to maybe push a trade, like writing trade tickets. Timing the market was very difficult too, because as you know, like bond prices shift a lot whenever the economy changes. Some say it's like a predictor for equities too. So it was just difficult to learn, I guess, the process for doing things. And after learning it, it was still kind of, this is a unique economic environment as well. So I'm not sure if being virtual hurt us more, but it made it more difficult to like assimilate or to like adapt initially. But if we were used to being virtual, I don't think it would be a much of an issue, but it probably hampered us a bit.
And just to follow up with what Azan said, definitely there was also external factors that were out of our control, such as the fires that we had. Some people had to evacuate at some points during the year. We had issues with just electricity, like blackouts, and just people having regular internet issues from being on our laptops a lot. So yeah, we definitely had to overcome quite a bit, but I think overall we did a great job.
Last question on a process side. Does the bond team and the equity team, when they model portfolio risk characteristics, do you combine the portfolios? Or is it just looking at the bond portfolio, Sharpe ratios, information ratios, et cetera?
So I can answer that, Dominic. We don't combine the portfolios. We have each of the teams separately look at those things relative to their those portfolios specifically.
Okay, and the reason I bring it up, Kelly, because this happens a lot with us. You know, we're a credit manager, and when we think about how we perform versus the ag long term, we typically beat the bag out of the aggregate index because we're putting on spread and we not as much duration. However, one of the purposes of fixed income is sort of your anchor, right, against volatility, which when you have downturns, correlations typically increase substantially and credit sells off the same as equities do many times. So when you're overweight credit, you're underweight treasuries, you're underweight that duration, it works until it doesn't. And that's when you want that insurance policy. So it's just something to keep in mind as you risk budget how much spread you want to put on the fixed income portfolio.
It's a really good point. Good thoughts. Thanks for that. I think at this point in time, we'll move on to the equity team. Bond team, thank you very much. And Dylan as well. Thank you for the presentation. We'll move on to equities.
And by the way, 500 basis points is a fantastic job anyway, you sliced it. So great job. Great job.
Thank you so much.
Yeah, and I really want to thank everyone for taking their time with us today. Our team consists of Alexis, Tanner, Kenny, Rohan, and myself, Ryan Joblin, and we'll be discussing the TCM equity portfolio today. Yeah, so today we'll be covering our overall strategy throughout the year, some of the trades that took place, our overall performance of the portfolio, and just our forward-looking. Yeah, so just on the strategy side, there's two things we looked at. One was really the consolidation of the portfolio, and then also second being the emphasis on strong verticals. On the consolidation side, really what we wanted to do was divest from small positions where we have like weak convictions on. And on the contrary, for positions that we had a really strong conviction, we actually wanted to increase some of the position size if they were small. When looking at different companies, especially on the screening process, we really wanted to look at strong industry verticals. So we would look at which verticals have the best growth or value proposition, but also what are the best companies within that vertical and what are we missing in the portfolio. So from the beginning of the year, we really wanted to increase the weights in financials, consumer discretionaries, while reducing the weighting in the staples, healthcare, and infotech. As you can see, we did increase our weighting in financials. We decreased our weighting in healthcare, and we also decreased our weighting in infotech. Yes, some of the trades that took place throughout the year were Bank of America, Facebook, Fortinet, Pulte Homes, American Express, and then Microsoft. To fund these trades, we sold Simon Property Group, Domino's, Abiomed, and Applied Materials. And just moving on to one of the notable trades that took place, we're just really going back to what verticals are we missing. From the beginning of the year, we knew that we're missing cybersecurity, and that cybersecurity was a critical industry to have in the portfolio. So when we're looking at Fortinet, the investment rationale behind it is it's extremely high scalability. It can really handle really large firewalls for databases and also 5G networks. And they're also getting into the ZTNA, so it's cloud security, which is going to be a major driver going forward. As well as the company has really strong financials coming in at 20% revenue growth, 17% margins. And I'll be passing it on to Kenny to talk about Pulte Homes.
Thanks, Ryan. So during this time the report was completed, there were convincing reasons why this would be a great addition to the portfolio, and they stem mainly from a macroeconomic perspective. So our rationale was pretty straightforward. At the time, the 30-year fixed mortgage rate was at lows that we hadn't seen in about 50 years, around 2.81%. And additionally, the Federal Reserve stated at the time that rates would stay near zero for quite a while. So this encouraged more home loans as well as purchases. And as history has gone to show, that it indeed happened. PulteGroup was attractive to us because of their on-site construction, as well as the brands in their portfolio that each had their own target market. On top of the discount they were trading at the time, it was an opportunity we couldn't sit on. And then since picking this up for the equity portfolio, it returned roughly 37% with a 0.92 contribution to the portfolio. Now I'll mention a trim that took place in the midst of the pandemic, which also stemmed from a macro point of view. So at the time, Biomed was the largest position in our portfolio and had already contributed greatly to our returns. But the concern was due to two main reasons. One being the decreased demand, as well as the possibilities of procedures not taking place. And two being that Biomed revenues were not very diverse. So Biomed is reliant on Impella products for most of their revenues, which means that impact with supplies and sales of the products are essential to future income. Physicians also are dealing with the financial fallout from the pandemic in 2021. Of the 3,500 physicians surveyed by the American Medical Association last summer, 81% reported that revenue was lower than the pre-pandemic levels, which is an average decline of 32%. So we saw an opportunity to trim our healthcare weighting and rotate into sectors that we thought would benefit down the road, such as financials. So with that, I'll pass it on to Tanner to discuss one of our recent buys.
Thank you, Kenny. So the final trade we will be covering is Bank of America. This is a position we already held in the portfolio, and with this trade, we effectively doubled our weighting from 2.5% to almost 5%. Why did we find value in this trade? First off, this trade fits in with our portfolio strategy to increase the financial sector weighting, and along with our purchase of American Express, will bring our financials weighting to match the benchmark. We anticipate the record savings rate and government stimulus over the past year will benefit Bank of America, as many worst case projections were avoided. Furthermore, interest rates have begun to rise, and the steepening of the yield curve is beneficial to Bank of America's operations. Due to Bank of America's higher leverage, we can expect that they will see higher returns than their peers in the recovery. This position has returned 11.5% since we purchased it on March 22nd. Now I'll move on to discuss performance. The Titan Capital Management equity portfolio has performed well over the fiscal year from June 30th, 2020 to April 30th, 2021. The portfolio returned roughly 41% during the fiscal period and had excess returns of 406 basis points over the benchmark. We want to take a moment and thank the previous classes for all their contributions to the portfolio's success. Over the long term, the portfolio has had outperformance of roughly 2% annually during the past 5 years, and we are thankful to have made our additions to this program. Moving on to our metrics, the portfolio has a higher standard deviation and a higher beta than the benchmark, indicating the increased volatility we've experienced. We had a lower Sharpe ratio than the benchmark and a tracking error of 3.06% and an information ratio of 0.18. We will now discuss how we achieved this performance. We benefited slightly from overweights in the communication services and industrial sector. We had superior stock selection in the financial sector through Bank of America and Charles Schwab, and superior selection in the healthcare sector through Abiomed and Intuit Surgical, both of which offset the negative allocation effect in their respective sectors. Additionally, we had superior stock selection in materials due to our holding Steel Dynamics, one of our fiscal leaders. Now we move on to some of our detractors. We had overweights in the consumer staples and healthcare sectors, both of which led to negative allocation effect. Additionally, we had an underweight in financials, which detracted from our performance. All of these weightings we have worked to rectify throughout the year, and we have largely met our goals. Finally, we had poor security selection in the information technology sector. This is primarily due to two holdings, Sienna Corporation and Alteryx, both of which were our fiscal laggards, and we will be discussing more in depth shortly. Now we move on to some of our leaders. Our first leader, Applied Materials, generated impressive returns of 118% over the fiscal period. Applied Materials benefited from greater than expected semiconductor demand exiting the 2020 COVID-19 pandemic. Many consensus forecasts were more pessimistic than actual results, and Applied Materials benefited from this. Applied Materials saw a Q1 2021 EPS growth of 38.4% year over year and a gross margin of roughly 45.9%. We exited this position on April 20th for an annualized holding period return of 28%. Our other leader, Steel Dynamics, saw impressive returns of 112% over the fiscal period. Steel Dynamics benefited from an increase in demand for steel as the economy began to reopen. Furthermore, rising commodity prices have helped boost revenues, leading to a Q1 2020 EPS growth of 33% year over year. Now we'll move on to some of our laggards, both of which were in the information technology sector. Ciena Corporation had a fiscal period return of negative 6.8%. COVID-related dynamics resulted in a short-term order slowdown. Expectations were high for Ciena, and many of these expectations were not met. In Q3 2020, management revised guidance down, which has hurt performance since. Despite these headwinds, Ciena saw Q1 2020 EPS growth of 26.1% year over year. Our other laggard was Alteryx, which saw fiscal period returns of negative 50%. Alteryx is another victim of high expectations. Despite a surprise beat on Q1 2021 earnings, Alteryx has not seen the growth that many investors anticipated. Alteryx continues to experience volatility and unpredictable profit margins, all of which contribute to our current sell rating on the position. I will now hand it off to Alexis, who will discuss some of our steps moving forward and our recommendations for the future class.
Thank you, Tanner. We will now briefly touch on the final pending additions to the equity portfolio. Shown on the left are the proposed buys, and on the right, the proposed sells. Our team strives to add about 2% to our Nike position through the sale of our Walmart holding. The thought process behind this decision is driven by the goal of increasing our overall exposure to the consumer discretionary sector while leaving behind the safe haven staples that Walmart has to offer. By executing this swap, we strive to capture reopening upside. Lastly, we have the proposed addition of ServiceNow funded by the sale of Alteryx. Through this execution of this swap, our team seeks to maintain exposure to the software industry while reaping the added benefit of the larger total addressable market that ServiceNow has to offer. And with that, we will now move on to our final remarks. A few words and lessons for the class of 2022 as we transition to the next cohort. First, we would like to reflect on the lesson that the market does not wait for anyone. Through these unprecedented times, we learned that it is imperative to move swiftly with conviction, and we hope to pass this lesson on for the next team. Second, we would like to recommend continued position consolidation of any positions less than about 2%. And finally, looking ahead, we recommend considering going green and adding some EV angles to the portfolio while considering going naked in traditional oil and gas. And with that, we will now open the floor up to questions. Thank you.
So the floor is open to questions, first from board members for the equity team.
What have you identified any names in the EV area or ESG area that could help the incoming class?
As of right now, we haven't identified anything specific, but we were kind of thinking of maybe metals within the battery space, a company offering that, or even charging infrastructure like the company Blink. Might be something interesting to look into just as things really grow. And we will need more infrastructure for that in the future.
What does it mean going naked on oils?
Yeah, I wanted to know that too.
Not having any oil or gas.
So you want to eliminate all oil and gas?
Why would you want to do that?
Because they're bad businesses.
Maybe
they're making a lot of money.
That says Jeff Van Technology.
They don't make a lot of money. They never do. They put it all on the ground. They're doing well though, for sure. Right now, there's been a recovery in energy prices.
Absolutely.
But here's you're certainly. I don't want to take away from Raymond and Bob's question. Maybe the question is, okay, if you don't want to own them, what would you own in the energy space? That's more traditional energy, not non-ESG.
Yeah, I would just say just to go on that, definitely the renewables. So clean energy. So some of the reasons why for divesting from natural Energy is just really increased regulation. There's also implications of tax credits, a little more granular, but just as a whole, the trends going forward, I think there's going to be more and more, or we believe there's going to be more regulation on oil and gas.
Fair
I
enough.
could, Jeff, go ahead and finish.
So I just was gonna say fair enough. I'll just make one comment, Bob, but it doesn't require a response. Renewables have, just to be fair, renewables have their share of issues too in terms of regulation and, getting good returns. So that's why I asked you, it is a tough space to invest in. I think it's getting better, but I think it really helped the incoming class if you could give them some guidance. Bob, sorry, go ahead.
No. Ryan or whomever, could you go back to the summary slide on the long-term performance? I had two areas to ask about. That was one, and then I wanted to ask you about the biomed position. So on this, obviously the raw absolute numbers have been really, really good. I wanted to ask you about the standard deviation. So the 5-year number is showing that the portfolio has been almost a third more volatile than the index. But I want to point out, standard deviation is one of a few metrics that tries to measure vol, and it is not perfect. And I believe that it penalizes upside volatility. The metric that I have found to be more useful in this area is called the Ulcer Index, but hardly anybody uses it. Do any of you know, or I would encourage you to maybe run things using that methodology, because it would be good to learn if your performance, your deviation, your higher standard deviation is more due to upside appreciation than just we're taking more risk. Have you had any discussions about that?
Yeah, Bob, that's an excellent question. In the past, we have looked at a little bit different, but Sortino's. So like looking at like downside volatility too, in the implications as well as upside. Recently, we have not though, and I think that's really that's a good recommendation going forward for the next class.
Okay. A biomed slide. So as we view that slide on the left, does this mean that in round numbers at one point, this was a $10,000 position in the mix and it became almost $70,000 and has collapsed to 20? Is that all accurate?
That chart also indicates trades that were made. So at one point, that is correct. They did buy around March 2020. They added to the position. It's the total market value of our position.
And has any of this been sold along the way? Or
Correct.
is it the portfolio rode it up and you've ridden it all the way back down? Is that the case?
We've had 3 trims along the way. It's maybe a little tough to tell, but they're the straight lines down. One was in November 2020. We had another one late 2020 as well. So we've bought and sold it.
Hey, Bob, sorry, that's a pretty misleading graph then. So I would certainly add those data points.
Well, that's what I can't see those lines on my computer. Can anybody else? Or
Because
But
without that clarification, it seems like the position, you let it run up 7x and then let it fall 80%.
Yeah, and that's where I was going, Dom. I wanted to ask what you've all been looking at all along, and could you have handled this better? What have you learned from it?
Yeah, I was gonna say that's our fault on the clarification. I think we could have framed it better for the chart. Yeah, it's a little bit misleading, the way it's framed, so.
Just go, sorry, Bob, have you finished?
Yeah, I think so, right? Thank you.
Yeah, the value, the point that Bob made on the previous chart about the 5-year volatility, 5-year standard deviation. It's not a hell of a meaningful thing having 5-year numbers, to be honest, when you're looking at standard deviation. If you really want to look at deviation, you should probably look at value at risk or something like that to show what your potential losses are and something like that. But the 5-year standard deviation is really just an academic number. It doesn't really mean a heck of a lot when you're in the weeds and things. It would really be nice to look at a value at risk, but that may be getting a little complicated for the professors to teach. I don't know. Jeff, have you got any ideas on that?
You know, I've always, first of all, I think as Bob knows, the market has turns up. The amount of volatility and rotation and with low rates, I have to say that a lot of risk statistics have just been warped. But that said, one of my favorites is up-down captures. I've always liked that.
Yeah.
And over time, I think that does good managers, my favorite managers are people that have like 100, maybe 100 plus upside and 90 on the downside. But I've seen great managers do, 115, 105, and they're really good at picking, they tend to play in more volatile spaces, but they do have some limit to their downside. So I think those are good stats. But by the way, I think these numbers are, what it would indicate on the surface this year is that maybe you got some return out of beta, but I'm not sure. And I think that's maybe why Bob and Ray are bringing it up. It maybe is it wasn't just a beta play. You had some really good stock picks. We actually place a lot of constraints on you by having you do value and growth and Russell 3000 value and Russell 3000 growth. And this is really great performance. So congratulations on that. But I think maybe what we're trying to get at is, how you can highlight this in a way that, there may be some more skill there than what we actually see in the statistics.
Yeah, Jeff, Ray, good points. Ryan, Ray brought up something I didn't realize. When you calculated this standard deviation, were you only looking at 5 data points because you're looking at 5 years? And if you were, I'd suggest changing that segment to at least monthly calculations so that you'd at least have 60 data points to analyze instead of 5, because to Ray's point, 5 would be very meaningless.
Yeah,
Bob,
Bob.
I can
Oh,
chime
sorry.
in on that, Bob. The students have been using a monthly 5 year, so 60 data points for the calculation for all of the
Okay,
statistics, 5 year, beta, Sharpe, tracking, those all have 60 data points.
Yeah.
okay. Thanks, Kelly.
One other comment this year, and I remember looking at the portfolios in one of my conversations with the students when I did, recently, you guys were short a lot of the big cap stocks up the top of 500. So the fact is you outperformed and you were short like Microsoft by a lot of weight and some other ones too, maybe Amazon, I'm not even sure, but you shorted what was like one of the best sectors in the market and you still had pretty good performance. So, I don't know, all of the whole risk, equities have just gone topsy-turvy. A lot of growth managers at one point were showing like upside captures and ETF funds too, by the way, like concentrated on tech. We're showing upside captures of 140, 150 with downside captures of 85. I mean, it's gone way, way just to places that we've never, I mean, literally Star Trek, we'd never gone before. So, you know, I overall, I think this is pretty good, but maybe think about how you could present it in a way that maybe teases out, you know, some of the skill. I think you probably, on the risk side, you probably did better than you think, just by looking at the stats. So it's good.
Yeah, good results, guys.
I guess I can chime in just a little bit. The information ratio of 0.18 kind of captures that a little bit. The guys had a positive alpha with a fairly low tracking errors. So 0.18 for a student portfolio, it's highly respectable in my opinion.
Thanks, Professor Kim. Thanks, equity team. Let's move on to the President's Scholars team. Last but not least.
Alrighty. So, good afternoon, everybody. My name is Keiichi Ono, and today I'm joined with John Redouty, Sean Harper, Dan Regan, Andrew Ochoa, and Gabriel Venda. And before I go on, I'd just like to thank everybody for the opportunity given to us students. Although it has been very unconventional with everything being completely remote, we have all learned valuable skills and experiences from the program that will be used for our future aspirations. And I have personally managed the President's Scholars portfolio since the fall semester, and it has been an honor working with the talent we have at Titan Capital Management. So today, the team will be discussing several topics, including an introduction, some lessons we have learned since taking over the portfolio, the performance of the portfolio, the asset allocation changes, and the leaders and laggards of the portfolio. So, one of my main goals as a portfolio manager was the mission to fund one scholarship to a President's Scholar. And thankful to say, we actually surpassed this threshold and generated returns of almost 26% for the fiscal year since June 30th, 2020. And this amount represents roughly $27,000 generated within our holding period, while the scholarship amount costs $7,000. And throughout the year, the team has made multiple changes to the portfolio, including an overweight to equity. And although the benchmark is 70% S&P 500 and 30% Barclays Aggregate Bond Index, we increased the equity allocation up to currently 80% to take advantage of the potential gains. And as a result, we've had positive risk-adjusted returns and preserved capital. And now I'll be handing it off to Dan, who'll shed some light on some of our experiences.
Hello, everyone. My name is Dan Regan. I've been a co-PM on the President's Scholars team for both my semesters at TCM. I'm going to be talking about some of the biggest lessons we learned in the past year. So the first one was to accept your losses when your logic is sound. When we first took over the portfolio and looked at our holdings in fixed income, we saw we had 20% exposure to emerging markets through the Matthews Asia Fund, which had been lagging recently due to high exposure to China during COVID-19. We felt this lagging performance would continue moving forward, so we chose to trim the security in order to fund a new position in high yield funds. In October, this went through and in the short run benefited us. However, in the long run, Matthews Asia began to recover and ultimately became one of our best performers in fixed income. We regret that we weren't able to better capitalize on its recovery due to the trim, but we could sleep at night knowing that we made a logical decision instead of chose to trim it based on a coin flip or tea leaves. Second major lesson that we learned was your models should inform your narrative, not define it. By the end of the summer, the President's Scholars team had overlooked the AT&T security at Communication Service Sector Request, who said it would lag. They also agreed that AT&T would probably lag moving forward. However, evaluation model performed on it said, if anything, it may be undervalued. So we put it to the side and didn't think about trading it for the rest of the semester. And during that time, it did not move out of the high $29 to low mid $30 range. Even into February, it still remained in that range. In spring, we did another report where we more accurately incorporated our beliefs that it was not best positioned in 5G and would have high expenses in order to remain competitive in 5G and fiber internet. Ultimately chose to swap the security for T-Mobile. And our final lesson was, if you see a deal in the market, so can the market. Speaks to the ongoing trend of analysts writing good reports on bargain price securities only for the market to react and move those securities up to fair prices before the reports can make it to the board, sometimes before the reports were even finished. We've been trading in an especially volatile time, so while it is tempting to say you just have to accept this, there were ways that we found to speed up our reports making it up to the board. First one being paired trades, where someone writes a buy, the other writes a sell, and that way, once they're both approved, they can be initiated right away instead of having to wait in the wings for a complimentary report. We also recommend that future TCM teams consider writing reports 2 people to 1 report in especially volatile times, or especially good deals you don't want to miss, because 2 analysts can write 2 reports in the same time either way. But if both write half of the first report, it gets done twice as fast and has a better chance of making it to the market in time. Now I'll be handing it back off to Casey.
Thank you, Dan. And now I'll discuss how we did it. So initially, when we got the portfolio, the team had a bullish outlook with the recovery in mind. And this was apparent through the decreasing initial claims for unemployment and the improving consumer confidence. We also saw wide spreads that were attractive, particularly in the high yield corporate sector, which the bond team discussed prior. And as a result, the team sought out increases in sectors that perform well in a recovery, like consumer discretionary, financials, and the high yield sectors. And although we may not have accomplished every single goal we had, the portfolio still performed well, which John will now go into detail.
Thank you so much, KG. Our performance for the portfolio was positive, outperforming the benchmark by 1.72%. We took minimally increased risk, with our standard deviation being 1.17% more than the benchmark, which has been annualized since inception. We did have a very high tracking error of 5.46 since inception, which was correlated to our increased risk to produce returns. This was paired with a relatively strong information ratio of 0.66. Moving on, the equity section of the fund has outperformed since its inception, but underperformed fiscal year to date as shown in the graph. The equity portfolio holds a 1.3 Sharpe ratio and a 0.5 information ratio. The tracking error stands at 7.6% since 2018, but it is 5.37% since June of last year. Our performance on a fiscal year date basis underperformed the benchmark by 5.15%. Much of our performance is attributed to an overweight in tech. These funds had a negative impact from our conservative 76% allocation in June, which we have thus corrected to 80% by March of this year. This is why the combined performance beat the 70-30 benchmark in both the calendar year and fiscal year, despite the equity performance lag. This was paired with our transition into consumer discretionary, which was behind the benchmark and resulting in an underperformance from fast market growth. Our biggest losers were Netflix and Chewy, which Andrew will discuss later. I will now pass it to Gabe to discuss our bond portfolio.
Thanks, John. Unfortunately, the fixed income section of the fund has underperformed since its inception, as shown in the graph. However, we have outperformed fiscal year to date by 1.72%. The bond portfolio holds a 0.23 Sharpe ratio and a negative 0.5 information ratio. The tracking error stands at 4.6 since 2018, but as of June 2020, it is 1.6%. The main contributors to this were our lower than benchmark duration, a 5.1 versus the Barclays US aggregates 6.4 as of April 30th, and a lower credit quality bias of A-. Much of our performance is attributed to underweights in treasury and securitized sectors and overweights in high yield, non-US, and investment grade corporates. Our biggest winners were the Matthews Asia's Total Return Bond Fund and the Schwab TIPS ETF. These funds benefited from high expected growth and a good COVID-19 response in Asian Pacific regions, as well as increasing inflation fears in the US homeland. Our biggest detractors were the Global X US Preferred Fund and the Barclays US Aggregate ETF. Now, here's Sean to speak about the allocation changes we've done to the portfolio.
Thank you, Gabe. So now we'll be discussing the sector allocation versus the benchmark. On the equity side of our portfolio, we are underweight versus the benchmark in infotech, healthcare, financials, consumer staples, and utilities. We are underweight in the healthcare sector because of our sale of Zeotis, whose funds were then used to fund additional investments in financials and communication services. The equity trade in the financial sector and communication services was Bank of America and Netflix, which we believe would be much better stocks to participate in the economic recovery that we projected earlier in the year. Furthermore, we wanted to swap out AT&T with T-Mobile because the company would be better positioned to capture the 5G market and because of AT&T's laggard position over the last couple of years, as Dan spoke to earlier. Our final trade of the semester on the equity side was to rectify our underweight in consumer discretionary by selling Conagra, which was in our consumer staples, to fund Chewy, which we believe will be able to capture much more of the growing market. Now moving on to the bond side. we are significantly underweight in treasuries, securitized, and IG corporates. However, we were overweight, or are overweight in high yield, non-US, and preferred stock. Throughout the year, we had increases in treasuries, IG corporates, high yield, and preferred stock. Back in October, the President's Scholars Fund trimmed Matthews Asia, as we previously spoke about, to reduce international exposure in favor of high yield, reflected by our purchase of a TCW high yield bond. Furthermore, we sold CMBS to switch into the USAA intermediate to diversify our exposure into securitized. We swapped the Vanguard intermediate term corporate to Thompson's Bond Fund for active management and shorter duration, which we also outlined as one of our intents at the start of the semester. Finally, we swapped Putnam for Global X to take profits from our muni trades, which were very optimistic, to buy preferred for yield cushion given the flat yield curve. Now we're going to be passing it on to Andrew to talk about our largest contributors and detractors.
Thank you, Sean. MetLife and Wells Fargo were the leaders of our portfolio. MetLife is up around 82% year to date and 97% cumulatively. This is primarily due to the rotation into financials, premiums and net investment income rebounding faster than predicted, and the company's worst case prediction not being realized. Moving on to Wells Fargo. Wells Fargo is up 79% year to date and 2% on an annualized basis. The rebound was attributed to lower than expected loan defaults, record deposits, extremely high savings rates, as well as a marginal increase in interest rates. All right, next slide, please. All right, so Netflix and Chewy were the laggards of our portfolio. Netflix has dropped 5% after we purchased it in March. This is mostly due to the market's recent sell-off of the company's conservative forward guidance for the next quarter. Our other laggard was Chewy. Since we bought Chewy last month, the stock has dropped 4.42%. This is attributed to the market's shift away from high multiple companies and the market reversal as a result of the current inflation fears. Despite the fact that these securities have lagged, we are confident in them and expect them to perform well in the near term. All right, and that concludes our presentation. The President's Scholars team appreciates everyone's attendance today and will be happy to answer any questions you might have at this time. Thank you.
Thanks, President Scholars. Questions for the President Scholars team?
Let's make a couple of comments. First of all, I love the what you said about the model in that it doesn't inform your narrative, or it informs your narrative, but it doesn't define it. That was brilliant. Who gets credit for that? Raise your hand.
Dan. That will be Dan.
That'd be me.
All right, way to go, Dan.
Thank you.
I love. That's all I've ever said about models. So I appreciate you putting it in a way that was more articulate than what I've ever been able to come up with. Just maybe one thing on the, this is very technical. When you were going through the bond sectors there, and you were showing which one, where you were overweight and underweight, I got the arrows, green and red. It was the color of the TCM portfolio, which I think was orange, and then the Barclays was the navy blue. It took me a while to find that, and then I finally found it. So maybe if you could put that like someplace where it's a little more obvious, where we could.
Sorry about that.
Just so it was a little more obvious, because I was getting distracted and a bit confused. So just a technical question there, but overall, great job.
Yeah, sorry about that.
No, it's I finally found it right at the end.
Any questions from any board members or anybody in the audience for the President's Scholars team?
I just had a question for the team. I saw Netflix, a new edition, is underperforming a little bit, and we just got Disney reporting, and they had a slowdown in their subscriber growth rate, which disappointed the market a little bit. Is the team still confident in Netflix and viewing the current sub growth issues transitory, or has the recent news changed anybody's opinion?
Yeah, I could talk about that. So I think the team overall is pretty optimistic regarding Netflix's growth. At the moment, they are giving out really conservative numbers, and I think that's just kind of the downplay that when they do earn their earnings next quarter, if they do surpass that, it's much more easier to say that we surpassed 1 million net subscribers rather than having a high expectation. But overall, much of the production has been halted since due to COVID-19. But as restrictions are loosened and more TV shows and movies are able to be streamlined, I think there will be an increase for subscribers and growth for the company.
I just had a question on the bond side. I know you mentioned that you've recently shifted to an 80-20 mix, and over the limited lifespan, the bond side has lagged, but the equity side has made up for it. And I know Jeff's got even more interest in this just because of what it does. I mean, the whole portfolio does great stuff, but because it's a smaller portfolio, I suspect you're very limited. You can't do individual credit analysis. So analyzing funds is a very different process. Have you found that to be challenging, and has that been anything that's been discussed?
Yeah, thank you for the question. So yes, because the portfolio is small, we are only able to buy certain like ETFs or mutual funds depending on the minimum investment requirements. So one of the things that we do is we just analyze. We first kind of have a top-down approach, just looking at the sectors, which ones we think will benefit moving on, especially since right now there isn't much opportunity, it becomes difficult. But once we do find an attractive sector, then we will look at certain mutual funds that are similar. And we would basically go to like Morningstar and then evaluate the portfolio managers and the historical returns and kind of identify which fund would be best for our portfolio.
Yeah, also just to add to that, as Kishi mentioned, we have kind of a top-down view. If we want to overweight or allocate more to certain sectors, sometimes it can be difficult to find a fund that has everything that you want. So sometimes it's almost like a bit of a compromise on the fund because, so say you want a specific type of credit, if the fund might not have it, it might just be kind of a broad, investment grade or just a broad kind of high yield. So it is a little bit harder to, I guess, kind of be more narrow to if you want something specific. So that is a limitation of the funds.
Yeah, I have just a comment. I'm not day to day, obviously, with the size of these funds. It would be nice on all the presentations if you could actually see beginning of the period dollar amount, how big the fund is, and the end of the period dollar amount, how big the fund is, just to get a feeling of, I don't really have a feeling of how the differences are. So if you could put those in the future, that would be good, please. Just to know what we're talking about in terms of dollar amounts. I didn't see anything anywhere in the presentations on that, but otherwise it's been good. Thank you.
Yeah, that's a great suggestion. And just to point out, we currently, when we initially started, we had around $105,000 under management for the President Scholars portfolio. And we have increased that $27,000. So it's currently at around $133,000.
Thank you.
Great. Any other questions?
Well, I had a question, Kelly, maybe for the professors. There are some differences with the President's Scholars. Maybe they're objective, but can they lever off the, if like they were going to, if the bigger portfolio is going to purchase a bond, say, can't we just do that at the same time in the President's Scholars portfolio? I mean, that's, so we do with some of our funds at Jackson Square. So I'm just curious if can be more interaction there so they can have the benefits of maybe a little more scale with a bigger fund.
I think, can I respond to that?
Yeah, sure.
I think the problem comes in, that would be fine on the execution initially when we buy, but then when we sell, we still will have a tiny piece of that original trade. And that's when we have our trouble. We're not going to necessarily want to get in and out of the trade at the same time with the other funds. So we haven't tried to consolidate in that way in the past. I think it ultimately would leave us stuck with things that we don't want.
Okay.
I would just add, Jeff, I think that the teams do leverage on research, like they do leverage off like the equity team and certainly off of the fixed income team in terms of funds. The other thing I would mention though is, as you stated correctly, the objective is a little bit different. So we do have to also consider the downside, capital preservation, because the fund does have the requirement of funding that scholarship. So that's another factor in addition to the small size that has to be thought of. But I guess that's kind of how I'd answer it.
Yep. Thanks.
If I could add on, because if you see me in the chat, I'm very proud of the team. They did a great job this year. They've done a really, really good job understanding the broad systematic factors that are impacting the market and trying to influence or impact their portfolio through these funds. They do a ton of look through to try and figure out, oops, there we go. They do a ton of look through to try and figure out, as Gabe was saying, which fund is going to give them the exposure they want with a minimal exposure to things they don't want. They're really thorough and thoughtful in the way they use the funds to implement their trade ideas. And I don't think this team has really found it an impediment not to be able to buy direct positions, if I can speak for them.
Yep. Thanks.
I would just like to say the managing directors have been great and supportive for everything we've done, and I do appreciate all their help they have done for us.
All right, I think that's all we have in terms of presentations. I know, Marcia, you stepped in a little late. I was gonna see if you wanted to you had anything you wanted to say.
Yeah, thanks. I'm sorry I was late. I was driving down from Tehachapi, and there's no such thing as COVID light anymore. Traffic. It was not pretty getting here. But I think just to echo what some of you were asking earlier about how has the COVID year impacted the students' experience, and they have done so well. I mean, they've worked really hard. They've collaborated together very well, even though to this day, there are still people who have never met in person, even though we've tried to have a few live events where we could, but not everybody was able to participate. So despite all of that, I don't think any of you could tell that those teams were not a united team. I mean, they were genuinely working together to achieve the mission. So as in the 7 years, I think I've been involved in TCM and ASAP now, I couldn't be prouder about all of the teams and how hard they've worked and how well they've navigated this really unique environment. So good job, everybody.
Yeah, it's great. It breaks my heart this year that we had this, horrible, because the program, we have a facility that's designed for physical collaboration. We didn't get to use it. So I'm really glad that, you can all get to, at least maybe some of you can get to Bob's dinner tonight, which just, again, I'm so sorry I can't be there. But I hope all the students this year, despite the fact that you had to do this remote experience, I hope you'll come back in the years to come, and then you'll have a little more of the community that maybe that you didn't, get to have this year, and have a good visit tonight. But this was a really extraordinarily hard year, and there were really great results, and another win with the CFLA. So, I mean, I don't know, the presentations keep getting better. It's just, and the program is so much more complete than it used to be in terms of people helping, and the, it needed some institutionalization, of which Marcia has really spearheaded, and all the professors. It's really professional program. So it's like, I hope this has been a great experience for all of the students, because it really is close, very close to what you will have to do in the real world, whether you're in an investment organization or not. So really, really good stuff.
Thank you.
Jeff,
Thanks, Jeff.
I booked the private JSP plane for you. You got to leave in 30 minutes.
Well, I know it's a killer, and
We'll see you. We'll see you in the fall.
oh yeah, I'll be down for definitely be back, and while I certainly, it would be too much to open up any discussions right now about some of the future plans for TCM that we've been, but I think we're going to have some other exciting things to be doing in the future with this program, and as soon as we can get back together in person, that'll be fun too. So I'm really, this is a tough year, but boy, it really, I mean, to be able to have this kind of presentation and then another CFLA one is just it's nothing short of greatness. Titan greatness.
I did want to state one other thing. So first of all, we do have some members from our class of 22 that are in the Zoom link today. And again, I just wanted to say, we're real excited to have you. You've seen kind of what the past team has done, and Professor Lucas, myself, and Professor Kim, as well as all the board members, are here to help you and to help you grow and be able to carry on the same tradition and legacy that the past teams have done. So welcome, and we're very much looking forward to you and in terms of the class of 22. And I'd also say that be sure to also use the alumni network. There was a lot of alums who were on this call today asking questions, being board members. The current list of students are going to be alums. So be sure to reach out to them because they can really help you in your journey in the program. And the culture we've built here is that they have been glad to help. And that was one of the things I was also telling the Smith leaders in the way that they've mentored the younger students. Well, in the same way, the TCM students that are alums will also be there and willing to help you. So be sure and reach out to them. We're all here to help you. We want you to succeed. And again, want you to do some of the same things that you just saw in this presentation today, as well as win competitions. We want you to be able to carry on that legacy and put you in a position to be able to do that. So welcome.
And don't worry if you don't feel like you can do that like tomorrow. It took them a while to get where they are. So don't freak out. We will help you get there.
Yeah.
Most definitely. You guys are in the best hands.
Yeah. Finally, I'd just like to thank all the board members for all their supports throughout the year. Congratulations to the class of 2021 for doing a fantastic job. And I'd like to send out warm welcome to class of 22. It will be a great year.
All right. And Marcia, Shane, anything else you want to add before we conclude for today?
No, everybody needs to celebrate, relax, have a great time, all your graduates after finals. Don't relax until after finals. And incoming class, it's going to be fantastic. I'm so glad you're here. We are going to have a great year.
All right, we'll see many of you at my house in about 90 minutes.
Thanks, Bob.
Okay. Thanks,
Looking
Bob.
forward to it.
Thank you so much.
Bob. Thank you, everyone.
Thank you, everyone. Thanks, everyone.
Have a great weekend. For
Good job.
those of you.
Thanks.
Bye-bye, everybody.
Bye.
Bye, everybody.